Hi. Let's learn about first mortgages. A first mortgage is a primary lien on a property. As the primary loan that pays for a property, it has priority over all other liens or claims on a property in the event of default. A first mortgage is not the mortgage on a borrower's first home, it is the original mortgage taken on any one property. It is also called a first lien. If the home is refinanced, then the refinanced mortgage assumes the first mortgage position. When an individual wants to buy a property, they may decide to finance the purchase with a loan from a lending institution called a mortgage. The lender expects the home loan or mortgage to be repaid in monthly installments, which include a portion of the principal and interest payments. The lender will have a lien on the property because the loan is secured by the home. This mortgage taken out by a homebuyer to purchase the home is known as the first mortgage. The first mortgage is the original loan taken out on a property. The homebuyer could have multiple properties in their name, however, the original mortgages taken out to secure each of the properties comprise the first mortgage. For example, if a property owner takes out a mortgage for each of their 3 homes, then each of the 3 mortgages is the first mortgage. The loan-to-value ratio on a home loan is a measure of the mortgage amount versus the appraised value of the home. If the LTV of a first mortgage is greater than 80%, lenders generally require private mortgage insurance, PMI. In such a case, it sometimes can be economical for a borrower to limit the size of the first mortgage to 80% LTV and use secondary financing to borrow the remaining amount needed. The economics of paying PMI versus taking out a second loan largely depends on the rate at which a borrower expects the value of their home to increase. PMI can be eliminated and the LTV of the first mortgage reaches 78%. However, a second lien, which typically carries a higher interest rate than a first mortgage, must be paid off. This is usually accomplished by refinancing the first mortgage for an amount equal to the remaining balance of both the first and second mortgages. The mortgage interest paid on a first mortgage is tax-deductible. This means that homeowners can reduce their taxable income by the amount of interest paid on the loan for the tax year. However, the mortgage interest tax deduction is only applicable to taxpayers who itemize expenses on their tax returns. First mortgage requirements can vary based on whether you're choosing a conventional loan or a government-backed loan, such as a Federal Housing Administration, U.S. Department of Agriculture, USDA, or U.S. Department of Veterans Affairs, VA, loan. These requirements can affect the type of property can also matter when getting a first mortgage. FHA loans, for example, allow you to purchase a 1 to 4 unit home with just 3.5% down and a credit score as low as 580. But the property itself must meet certain standards to qualify for the loan. The term first mortgage leads one to understand that there could be other mortgages on a property. A homeowner could take out another mortgage, such as a second mortgage, while the original and first mortgage is still in effect. A first mortgage represents the primary debt owed on a property, which serves as collateral for the loan. A second mortgage is a junior lien that you take out against your home when you still have a first mortgage outstanding. Second mortgages are subordinate to first mortgages. So if you sell the home, for example, any proceeds would go toward paying off the first mortgage, then the second mortgage. Common examples of second mortgages include home equity loans and home equity lines of credit. You may take out one of these second mortgage loans if you wish to borrow against the accumulated equity in your home. Here are 4 key takeaways. 1. A first mortgage is a primary lien on the property that secures the mortgage. 2. The second mortgage is money borrowed against home equity to fund other projects and expenditures. 3. If the loan-to-value (LTV) ratio of a first mortgage is greater than 80%, lenders generally require private mortgage insurance, PMI. 4. The mortgage interest paid on a first mortgage is tax-deductible, only applicable to taxpayers who itemize expenses on their tax returns. Hope this would help. Thanks for watching.